In the United States, the expected change in growth drivers has materialized. We have observed that private consumption has slowed down and investment has picking up. Overall, the situation is pretty good because the labor market is robust and wage inflation is rising. That will support consumption. And regarding investments, the combination of huge US fiscal stimulus and a global and synchronized industrial cycle definitely speaks for further investments. Overall, the situation in the US is pretty good. And we believe that it means that both short interest rate and long interest rate, which means actually the whole yield curve, will go up in the coming months. We have observed in April that the 10-year Treasury yield reached for the first time for years the 3% level, and we believe there is still room for higher rates. And we recommend to keep a short duration. In the Eurozone, the situation is a bit different. We probably observe in the first quarter of the year peak growth, but still leading indicators are good. And for us, it means that we have to get ready for the next step. And the next step is definitely the end of quantitative easing in Europe. That will take place later this year in the second half of the year. We do not expect any rate increase this year, but still we think that this is the right time to shorten the duration and to manage interest rate risk also in Europe. Just please note that peripheral bonds remains attractive in our view, and we continue to believe that interest rate will converge in the futures. The global economic picture is very supportive for equities, but still there is some element that speak for caution. For example, we have increasing interest rate, we have high expectation, high valuation, and peak growth in the Eurozone. All in all, this combination of factors speak for some caution and lower exposure on the equity side. Looking now at corporate bonds, they have done very well in the last couple of years. But we believe that we are in a late business cycle, and it means that this is time to improve the quality of bond holdings. With higher quality, the expected yield is lower, but with higher quality, the sensitivity to an adverse shock is also less important. Goodbye and see you soon.